What is it that makes a brilliant investor? What are the qualities that enable a man or woman to take, let's say, $10,000 and turn it into $200,000 or $300,000? Tonight we're going to be talking with three of the greatest investors of a generation. At least two of them are legendary. They have very different personalities, different lifestyles, different investment philosophies, but what they have in common is their enormous success. Success measured not only in the millions of dollars, but in the respect of their peers. Now, it wasn't very long ago that there came about in universities a theory, after a lot of statistical study, that said no one can beat the stock market. That if you're up one year, you're down the next. And that all the information about any stock is in its price. In other words, the markets are efficient. But here are three brilliant investors who stood that theory on its ear because they have won year after year after year. The most senior in years is John Templeton, who came from the small rural town of Winchester, Tennessee, went to Yale, graduated first in his class, went to Oxford as a Rhodes Scholar, made his first investments on the eve of World War II. He thought then that Germany's invasion of Poland would put the U.S. on a war footing and bring it out of depression. So he called a broker and bought $100 worth of every stock selling for $1 a share or less, all on $10,000 of borrowed money. 4 years later, he sold them for $40,000, and he has been a bargain hunter ever since. His mutual funds all carry his name, Templeton, in their titles. The oldest of them is now 31 years old. Today, John Templeton runs his funds from the Bahamas, where he's built a home reminiscent of the antebellum mansions of his boyhood Tennessee.
Mostly died out.
It's very pleasant here in the Bahamas, but how can you run a couple of $1 billion worth of investments from a surrounding like this? Don't you have to be on Wall Street?
We did move here because it is so very pleasant. But we now have found that in the 22 years we've lived here, the performance of our mutual funds is better than in the 25 years we were managing them from Radio City in New York.
Well, how do you account for this? I mean, you could work at Radio City and do things differently.
Yes, we tried to, but we go to the same meetings as the other security analysts, and the people who speak are so sensible that we can't help being influenced. It's much easier to be odd when you're 1,000 miles away.
Trying to be odd, going against the herd, has been a Templeton trademark as he searches for bargains that others have overlooked. How do you know? You've always said that you should sell when the herd is happiest and buy when it's gloomy. How do you know when the herd is gloomy that it isn't right?
Sometimes they are, and of course we make hundreds of mistakes all the time. But we have found, from the very time we started our investment council operation 44 years ago, we published as the motto of our business to buy when others are despondently selling, and to sell when others are avidly buying requires the greatest fortitude and pays the greatest reward. Now, this applies not only to stock market cycles, but it applies to particular industries and types of stocks. Basically, we determine that by finding out what is selling at a depressed price. If a stock is selling for a quarter or a half of what it's worth, then it is a bargain and is, in most cases, unpopular with other investors.
Mainly you like to buy companies that are out of favor. For example, I noticed that your biggest position is in Royal Dutch, but everybody's expecting oil prices to go down. Doesn't that bother you?
Oh yes, of course it bothers us, but there's so many other factors. We do own a very large amount. In fact, I think Royal Dutch Petroleum is the largest holding in our mutual funds, because at the present price, it's selling for only 4 times what we think it will earn this year. And we estimate that in the long run, it will earn more. And it's selling for less than half what it could liquidate for, and only about 3 times its present annual cash flow, and pays a good dividend. So for many, many reasons, it looks like the best bargain in the energy industry. It's very widely expected that there will be a decrease in the price of oil, and if the low point for share prices is when the most investors are expecting bad news, not after the bad news comes out. Now, it is possible that it might get lower, but we are long-range investors. Our average holding period is 6 years.
6 years.
So in the long run, it'll be worth much more.
Your global fund looks all over the world for investments, and I noticed that a couple of years ago you were heavily into Japan, and now you've brought all that money practically back to the United States. Isn't that true? Is that a temporary phenomenon?
Yes, that is temporary. We are worldwide bargain hunters. We search all over the world and make estimates of the values of each corporation, and then buy those shares that have the lowest market price at the time in relation to our estimate of value. And at one time, that was in Japan. In that one nation alone, we had over 50% of our total investments because we were buying the very finest companies at 3 times earnings, some at 2 times earnings. But now, instead of 50% in Japan, we're less than 3% in Japan because meanwhile, the prices there have gone up. The Dow Jones Industrial Average in Japan is now over 25 times earnings, and the index of smaller companies in Japan's over 41 times earnings. So that now there are very difficult and very few bargains to be found there, and more bargains to be found in America and other nations.
Well, if you're looking around the world, what country or countries would you pick as the best shot?
We never approach it that way. Almost all security analysts ask themselves which nation and which industry before they make a selection. If no one were doing it, that would be a good method. But since the best results are obtained in those areas where other security analysts are not working, we just say we will buy the best bargain we can find, then later find out what nation it's in. Now, approaching it from that end, we have found an unusually large amount of bargains recently in the United States, also in Canada, and in Australia, and in the Netherlands.
John, 3 years ago, you said that you could see the Dow Jones at 3,000 within 5 years, which was almost a triple and certainly a double. You have 2 years left on that prediction. Do you hold by it?
We keep changing. What I said, and we do not ordinarily make predictions, but I said that the chances were as good as even that would happen. And I'm saying today that the chances are as good as even that the Dow Jones someday might be above 3,000 before the next presidential election 3.5 years from now. We base that on a long list of reasons, partly based on value and partly based on cash available.
How do you feel personally about the current takeover mania?
It's an illustration that share prices are among the best bargains in the world. This takeover mania proves the fact that corporations on the stock exchange are selling for much less than they're really worth. Also, the same thing is proven by the fact that more corporations than ever are buying in their own shares. So that it's a further evidence that values are unusually low now.
Academicians have a theory that no one can beat the market consistently, that the markets are efficient, that all the news is already in the price. And yet there are a handful of great investors who have single-handedly disproved that theory by consistently beating the market over a period of many years, and you're one of them. How would you distinguish yourself, say, from Philip Fisher or Warren Buffett?
Probably in the fact that I look worldwide more than the others do and search in a wider variety of areas. Probably because I'm willing to make estimates of earning power further into the future than others are, and certainly because I rely on prayer in everything we do. We open all of our directors' meetings with prayer. We pray about every decision we make, and in the long run, that means you will still make hundreds of mistakes, but less mistakes than otherwise.
Did they ask you whether you prayed for stocks to go up?
Well, yes. That would not work, of course. If we prayed for something we bought to go up, it would be ridiculous. So instead of that, I think we would try to follow Solomon, who prayed for wisdom.
Templeton has offered a prize for religious work and thinking, but there are others with a more secular approach who have also been very successful. Let's take Warren Buffett of Omaha, Nebraska. If you had put $10,000 in 1965 into his company, Berkshire Hathaway, you would have $1 million today. Warren was a chapter in my 1972 book, Super Money, so I've known him a long time. He learned his trade with Ben Graham, the original dean of security analysis at Columbia University. I don't think Warren has ever been on television until this interview, and he has certainly never courted publicity, but recently he got a lot of it when he emerged as the key figure in the takeover of ABC by Capital Cities. Warren will be the largest shareholder of the new company, and his own net worth is now far in excess of $500 million. But when I spoke with him last fall in his office in Omaha, he very characteristically made his investment style seem so perfectly simple.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
Warren, what do you consider the most important quality for an investment manager?
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Because this is not a business where you take polls, it's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right.
Warren, what do you do that's different than 90% of the money managers who are in the market?
Certainly most of the professional investors focus on what the stock is likely to do in the next year or two, and they have all kinds of arcane methods of approaching that, but they do not really think of themselves as owning a piece of a business. The real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price. Yeah. And I can look at the price occasionally to see whether the price is outlandishly cheap or outlandishly high. But prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is.
So Buffett chose to stay in this world, Omaha, Nebraska, where corn grows just minutes from downtown. Now, Omaha is a nice town, but nobody claims it's a world financial center. Here, the only thundering herd is actually on 4 feet. Don't you find Omaha a little bit off the beaten track for the investment world?
Well, believe it or not, we get mail here, and we get periodicals, and we get all the facts needed to make decisions. And unlike Wall Street, you'll notice we don't have 50 people coming up and whispering in our ear that we should be doing this or that this afternoon.
You appreciate the lack of stimulation here?
I like the lack of stimulation. We get facts, not stimulation here.
That's terrific. How can you stay away from Wall Street?
Well, if I were on Wall Street, I'd probably be a lot poorer. You get overstimulated in Wall Street, and you hear lots of things, and you may shorten your focus, and a short focus is not conducive to long profits. And here I can just focus on what businesses are worth, and I don't need to be in Washington to figure out what the Washington Post newspaper is worth, and I don't need to be in New York to figure out what some other company is worth. It's an intellectual process. And the less static there is in that intellectual process, really the better off you are.
What is the intellectual process?
The intellectual process is defining your area of competence in valuing businesses, and then within that area of competence, finding whatever sells at the cheapest price in relation to value. And there are all kinds of things I'm not competent to value, but there are a few that I am competent to value.
Have you ever bought a technology company?
No, I really haven't.
In 30 years of investing, not one?
I haven't understood any of them.
So you haven't ever owned, for example, IBM?
Never owned IBM. Marvelous company. I mean, a sensational company, but I haven't owned IBM.
And so here is this technological revolution going on, and you're not going to be a participant.
Gone right past me.
Is that all right with you?
It's okay with me. I don't have to make money in every game. I mean, I don't know what cocoa beans are going to do. There are all kinds of things I don't know about, and that may be too bad. But why should I know all about them? I haven't worked that hard on them. In the securities business, you literally every day have thousands of the major American corporations offered to you at a price that changes daily, and you don't have to make any decisions. You have to make nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you, And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients start yelling, "Swing, you bum!" From the stands, and that's very tough for people to do.
Warren, your approach seems so simple. Why doesn't everybody do it?
Well, I think partly because it is so simple. That the academics, for example, focus on all kinds of variables. Partly because
by academics you mean professors of
right,
finance.
The data's there
in business school.
Sure, and the data's there. So they focus on whether if you buy stocks on Tuesday and sell them on Friday, you're better off, or if you buy them in election years and sell them in other years, you're better off, or if you buy small companies. There are all these variables because the data are there, and they've learned how to manipulate data. And as a friend of mine says, to a man with a hammer, everything looks like a nail. And once you have these skills, you just are dying to utilize them in some way, but they aren't important. If I were being asked to participate in a business opportunity, would it make any difference to me whether I bought it on a Tuesday or a Saturday or an election year or something? It's not what a businessman thinks about in buying businesses. So why think about it when buying stocks? Because stocks are just pieces of businesses.
Both Warren Buffett and John Templeton are interested in the philosophy of value. They are not short-term speculators, and they aren't known for accepting high risk. But our next great investor relishes risk. In fact, if an opportunity isn't risky, he isn't interested. Robert Wilson has been tremendously successful following a strategy that focuses on stocks whose earnings are growing rapidly, and he bets against those whose earnings are going down. Wilson lives and works in the heart of New York City. When he's not managing his money, he spends his time as an avid patron of the arts. He's on the board of the New York City Opera and enjoys shop talk with General Director Beverly Sills as much as stock talk with his brokers. Some of the great investors do better out of New York. John Templeton lives in his flower garden in the Bahamas, and Warren Buffett lives in Omaha, Nebraska, and both of them say that living out of New York keeps them out of everyday gossip and the hurly-burly of flow of overload of information. How do you survive in New York?
Well, in the first place, I would be bored to death simply living in either the Bahamas or Omaha, and so the most important thing is to enjoy life. But secondly, I never really did all that well in the market until I came to New York. Unlike these other distinguished gentlemen, I am not an original thinker. I tend to rely on other people to feed me, if you will, ideas. And I'm very interested in what a lot of other people are thinking. And more bright people are in New York in this business than anywhere else. I think the difference really is that they are original thinkers and I'm not. I'm a derivative thinker.
A lot of people say you can't beat the stock market consistently, and certainly a lot of money managers say the stock market has beaten them, but you have beaten the market, and very consistently. What's the principle that you've used to do this?
My philosophy is basically to invest in stocks where earnings are growing rapidly at the time when I'm investing in them. Conversely, to short stocks where earnings are contracting rapidly, or where the earnings are illusory for one reason or another. I lead a rather placid personal life. It's been a quiet, pleasant life. And the market provides to me the excitement and drama. I like to be in things that have great potential for huge gains, or in the case of shorts, great potential for losses. I often tell brokers who give me ideas, I say, I'm not interested in buying it if it can't go down 30%. I'm not interested in stocks with limited downside risk. If the downside risk is limited, then the upside potential is probably also limited. So part of it is a way of getting vicarious excitement out of an otherwise rather placid life.
Well, how do you find the companies that have the rapidly growing earnings?
Well, I really rely on brokers to call me. I give a lot of money out in commissions, and I tend to sit at my desk waiting for people to call me.
But rapidly growing earnings, those companies are prizes. They are scanned for by computer screens. Emerging growth mutual funds look for them. Isn't this quality already reflected in the price of each of those stocks?
Maybe I can refine what I said. The only way one makes money in the market is when the market's perception of a stock changes. So basically, I am looking for stocks where perhaps the earnings have not started to improve yet, or if they have started to improve, they are going to accelerate. There has to be an improved perception of that particular stock and that company to make money. So you're absolutely right about that. To buy a stock simply because earnings have been going up 30% a year for the last 3 years, and to just do that on a rote basis could be a very good way to lose money fast, because when the earnings slow down, the stock could easily go down.
Tell me about the short side. That's what characterizes you as a little bit unusual.
Yes, about the short side.
Well, first, we better tell people who don't know what that is.
Well, and when one buys a stock long, one buys a stock and then later sells it. In the case of a short, one sells the stock first and then buys it later. Now, how can one do that? Well, let's say you are bullish on IBM and you own some IBM stock, and and you think it's going up in price, and I think IBM's going down in price. I say to you, let me borrow your stock and I'll pay you for borrowing it, just as I would have to pay you if I borrowed your money. And I will borrow the stock and I'll return it to you at some future date that we would agree on. And so I will go out and sell it. And if it goes down, I will make money because I can buy it back and return it to you at a profit. If it goes up, you're the one who makes the money and I lose money.
So you would sell a stock at 50 and buy it back at 25, hopefully.
Hopefully, yes.
Later. Haven't you had an experience on the short side that was at least chastening?
Yes, indeed. During the 1970s, when the stock market was by and large going down, I shorted, I would think, 1,000 different stocks, and may have been wrong about 5 times. I mean, I was almost godlike in my ability to pick shorts. And you know it happens to gods who inhabit earth rather than the heavens. They begin to think that just because they short a stock, it will go down. And this happened to me in the case of Resorts International, which I shorted because I did not think Atlantic City would amount to anything as a gambling center. And the earnings came in, and I was just so sure that because I had shorted it, I would be right. It was hubris sort of run riot, and it's a very human thing, and it happens to all of us. And I think it particularly happens on Wall Street. We tend in this business to be terribly right for a while, or terribly wrong. And no matter how often we have been wrong in the past, when we have a period when we are right, it's so wonderful, and we think we're so good.
Well, what happened?
And, well, I lost a great deal of money, and I made the front page of the Wall Street Journal. I'd often aspired to make the front page of the Wall Street Journal, but not quite in the role that I made it.
If a young person came to you today, just out of college, and said to you, when I'm your age, I want to be as rich as you are, or where you are today, how do I do it? What would you tell them? Money in the abstract, not what money will buy, but money in the abstract has to be the most important thing in the world. It is not the most important thing in the world to the vast majority of talented people. Do you have an end object in mind in your investing career? Yes, to make $1 billion. Really? Yes. I'm not at all sure I'll be able to do it, but I'm going to try. It isn't really so important that I do it. The important thing is to try to do it. I think you can see that as different as these 3 remarkable investors are, they have some traits in common. They have independence of mind. They're not afraid to act alone when the crowd's going the other way. They trust their own perceptions. They stick to the style they know, and they are all smart. They all probably would have succeeded at anything they turn their hands to. And finally, and most significantly, after decades of investing, they still find it so much fun they can rarely stand to do anything else.